Welcome to the lesson. We are going to answer question 2. That is April 2024. Question 2. A, B, and C. A, B is just 4 marks. Differentiate between a unit trust and a mutual fund. Candidates were to give just 2 points to distinguish unit trust from mutual fund. And candidates, these two, the unit trust and the mutual fund, are both collective investment schemes that pool money from multiple investors to invest in diversified portfolio of assets. You understand? Both are collective investment schemes. Both collect money from different investors, and that money that is collected from different investors is invested in a diversified portfolio of assets. Now, when distinguishing such schemes, distinction can be on the basis of the legal structure. The legal structure, how are they formed? You can get a distinction by looking at their legal structure. And the first one here is which one? The unit trusts are or is structured as a trust. All right? The unit trust, the name even suggests that it is structured as a trust with a trustee holding the assets on behalf of the investors. Remember, I said that both unit trusts and mutual funds are collective investment schemes that pool money from different investors, and then they invest in assets. So unit trust is structured in a way of a trust, and trusts we know have trustees. So a unit trust must have a trustee who holds the asset on behalf of the investors. That is the structure of a trust. For the mutual fund, now mutual funds are typically structured as corporations or investment companies. A mutual fund is a company and is formed based on it's just like a normal company, right? The Companies Act is governed by the provisions of the Companies Act. So a mutual fund is a corporation or an investment company with a board of directors. All right? Remember, we are distinguishing based on the structure. This one has a board of directors, but a unit trust has a trustee who holds the assets on behalf of the investors. But for the mutual fund, it is a company that has a board of directors that oversees the operations of the fund. So that's the first distinction based on the structure. Another way to distinguish the two is trading. Trading, all right? Now, as for the unit trust, the units are bought and sold directly with the fund manager at a price that is determined by the net asset value of the underlying assets. All right. Now, units are just like shares. When you invest in a unit trust, you buy units. And we are saying here the units are bought and sold directly with the fund manager. You understand? We are talking about trading. How do you buy the units? If you are to invest in a unit fund, the units are bought directly from the fund manager and they are sold through the fund manager at a price that is determined by the net asset value of the underlying assets of the unit fund. How about trading of mutual fund? Now, remember I said that mutual fund is a corporation. It is a company. And if it is a company, then we are dealing here with shares. If it's a mutual fund, then the shares are bought and sold on a stock exchange at a price that is determined by the market demand and supply. Okay. Now, there are many more distinctions, but we will not go much into the distinctions. But I'm just helping you. When you are distinguishing such, you can distinguish them on the basis of the structure, legal structure, on the basis of trading, and you can even distinguish on the basis of benefits. Okay. So that is the distinction you are to give true to earn the 4 marks. Let's move on to part B of the question. Sophia Wambia intends to invest 2 million shillings in a 12% debenture for 3 years. The current market value of the debenture is 80 shillings per debenture. The required rate of return on the debenture is 10% and the par value is 100 shillings. Required, advise the investor on or not to invest in the debenture. 4 marks. Okay. Sophia Wambia intends to invest 2 million in a 12% debenture for 3 years. The current market value of the debenture is 80 shillings per debenture. The required rate of return on the debenture is 10% and the par value is 100 shillings. Advise the investor on whether or not to invest in the debenture. So that is a question. 4 marks. 4 marks. So how do we go about this one? How do we go about? Now, what will be the basis of this advice? Because we need to do some calculations before we advise. Now, to advise Sophia, we'll be required to have 2 variables. That is a value of the debenture. We'll have to calculate the value of this debenture. Then we compare the value of this debenture with the market value of the debenture. So we just need 2 things. The value of the debenture. How do you calculate the value of the debenture? We calculate the value of the debenture, then we compare that value of the debenture with the market value, the current market value of the debenture, which is given 80 shillings per debenture. The amount shown there, 2 million, is irrelevant. Someone is asking, this question falls under which topic? This is valuation. There's a topic on valuation of securities. That should be topic number. It's on valuation. The topic part B is valuation. Part C is different topic, but part B is on valuation. So I've given the direction. We need to calculate the present value of the future debenture cash flows. Then we deduct the market value of the debenture. Then we can advise based on the answer we get. This is B. We are going to compare two things. Okay? And that will give us, it's like an NPV. You're going to have the present value of debenture cash flows minus the current market value of the debenture. The current market value of the debenture, we have it, it's 80 shillings. But we do not have the present value of the cash flows expected to be derived from the debenture. To determine the the value of a debenture, we get the present value of the expected cash flows from that debenture. And from the question, this debenture has two cash flows. One is the interest. All right. The current market value of the debenture is 80. Then there is that interest. Sophia Wambio intends to invest 2 million in a 12% debenture. That 12% is the interest that Sophia is expected to receive from this investment for the period of 3 years. 12% debenture for 3 years. That interest is the expected cash flow from the debenture. Then at the end of the 3 years, Sophia will get back the par value, that 100 shillings. The required rate of return on debenture is 10%, and the par value of the debenture is 100 shillings. Okay, that is the par value. That is the par value. So we are going to get the present value of these two cash flows. We deduct from the current market value, then we'll advise. So that is the formula. Anything else is just workings. So step number 1, put down the formula. Then check from the question if you have the inputs. Already we have the current market value, but we need to calculate the present value of the debenture cash flows from the debenture. And I've said that there are two cash flows, interest and the par value. So the present value of a debenture, the formula, the present value of the debenture will be the interest times present value interest factor. The rate here is 10%, 3 years, plus this is an annuity, supposed to be annuity, present value interest factor of annuity. It is an annuity, 10%, 3 years. We add the par value times present value interest factor. This is an interest, is a lump sum, 10%, 3 years. So Sophia will be receiving interest at the rate of the rate is 12%. So therefore, candidates, what is the interest? The interest is 12% of the par value. That is the interest. This interest. Interest is 12% times 100. This is the interest times this factor. What is the factor from your tables? Annuity factor. 10% 3 years. Annuity factor 2.4869. 2.4869. So that is interest. This is how to calculate interest. You take the interest is given 12%. Okay? Times the par value, 100 shillings. So we multiply the factor 2.4869. That will give us a present value of the interest. Then we add the par value. We discount the par value. This 100 shillings will be received at the end of the third year. So we discount it. So that's going to be 100 times present value interest factor, 10% 3 years. What is the factor? 0.7513. 0.7513. Okay. So how much is it? 12% times 100 is just 12 shillings times 2.4869 plus 100 shillings times 0.7513. How much is it? 104, 97, 96, 104.97. 104.97 28. That is the present value of this debenture, 104.9728. What's the difference? Is it positive or negative? It is positive. That is positive. Frigid. What is the present, the net, the NPV? How much? Positive 24.97. 24.9728. Advice. You see, this is positive NPV. That is the positive NPV. Advise the investor on whether or not to invest. The advice is invest. Invest. Why? Because it yields a positive NPV. The NPV is positive. So someone had asked the 2 million. That 2 million is irrelevant. The 2 million is irrelevant. Maureen is asking, how are you getting 24? Is the difference. The difference between 104 minus, there is 80 here, the current market value. That's how we are getting 24. That clear, Maureen? Yeah, there is 80. Maybe you came in after we had written it. To advise this client, you have to calculate the present value of debenture cash flows. Then you compare with the current market value. The current market value. If it's positive, the investor can invest. If it's negative, then you should shun away from such investment. All right. Can we proceed? DML is asking, in what scenario could have the 2 million been relevant? In what scenario could the 2 million have been relevant? Now you see that 2 million is like it is a root. It's just a root to the question. The 2 million is a way of making the question look practical. You have to imagine that the investor would invest 2 million shillings. The question can be varied in many ways, including number of debentures. You can use the 2 million to calculate the number of debentures. Like this investor has 2 million shillings and wants to invest in a debenture whose market value is 100 shillings per debenture. So how many debentures is Sophia likely to buy? So the question can be varied from that angle. If you want to know or calculate the number of debentures, the 2 million can help you determine the number of debentures. And that's why DML, you need to look at, we'll be looking at different questions, how the valuation of debentures, the questions can be varied. I think there are a number of questions in past papers. We'll be seeing how the question can be varied. So we look at different scenarios as we move along. We will have an opportunity to work out similar questions, but tested in various ways. But the 2 million, most candidates were confused with the 2 million. Some candidates worked with the 2 million shillings. And the moment you begin to work with the 2 million, then you see you get it wrong. You may not be able to advise, because using 2 million will not get you anywhere, because the question was very specific. Advise the investor on whether or not to invest in the debenture. And that's why I always say it's important to take a break and understand the question, then find out what may be the formula to answering the question. And there is no specific formula. The formula may vary depending on the question. There is no, the formula sometimes is not standard. Okay, it's not like the formula for calculating area of a circle. No, here the question, the formula can vary. Whichever way a question is tested, as long as it's computational, there has to be a formula, and the formula is just an approach on how to answer it. When I say formula, I'm not referring to the formula in the book. No, every problem is unique, and if every problem is unique, then it calls for a unique approach or formula or a way to solve it.